Hello friends. In the previous videos we have discussed about material variances and labor variances. Today we are going to talk about overhead variances, and when we say overhead variances we are going to talk about both variable overhead variances and fixed overhead variances. So let's jump into the video. When we talk about overhead variances, first we need to understand what is overheads. So overheads are indirect cost. Overheads are indirect costs which are required or which are incurred in my manufacturing or in my product, right? So what are indirect costs? So indirect costs are costs which are not directly associated with the production process. Say for example, let us take the factory rent. Now to manufacture any product, I do not need to incur, or the manufacturing of a product is not associated with my factory rent. However, the factory for which I am paying the rent is supporting my manufacturing activity. So it is not directly related. It is not directly related to my production. So those are called as overheads. Now overheads are divided into two. One is variable overheads and the other one is fixed overheads. Variable overheads and fixed overheads. So first we will discuss what is variable overhead. So variable overheads are overheads which are in the nature of variable. When we say variable, what does that mean is, let's say I require 10 rupees of material to manufacture 1 unit of a product. Right? So if I am manufacturing 1000 units, my cost would be 10,000. If I am manufacturing 2000 units, my cost will be 20,000 units. So variable cost or variable overheads are expenses or overheads which increases with the increase in my production, right? They are constant. Constant per unit. They will be fixed. However, they will increase with the increase in my production. If for 1 unit I require 10 rupees, for 2 units I will require 20 rupees. If for 10 units I will require 100 rupees, and so on. However, on the other hand, fixed overheads are fixed in nature. That means they are fixed in totality. They will not change with the level of production. Let's say for example, rent will remain constant. It does not matter if I am manufacturing 1000 units or 2000 units, my rent will remain constant. First, let us discuss about variable overhead variances. So the formula to calculate variable overhead variances, the formula to calculate variable overhead variances is, it is similar when we talk about variable overheads, it is similar to labor variances. It is very similar to labor variances. However, there is slight change. What is the change? We will discuss now. So the formula is standard cost for actual production. Standard cost for actual production minus actual cost. So let's say in labor we had standard cost minus actual cost. In material we had standard cost minus actual cost. However, when we discuss about variable overheads, the formula changes slightly, which is standard cost for actual production. Minus my actual cost. Now what is standard cost for actual production? Concept wise it is still the same. It is still my standard cost. However, However, we refer to it as standard cost for my actual production. Why we call it standard cost for actual production is, in variable overhead or any overhead problem, the problem will give us what is the budgeted quantity. What is the budgeted quantity? Based on the budget, my overhead cost is estimated or planned. Based on the budget, my overhead cost is estimated or planned. However, we cannot take the budgeted quantity to be my actual output. We cannot take my budgeted quantity to my actual output. My actual output will be the output which I have actually manufactured. So the standard should be based on the quantity which I have actually manufactured. The quantity which I have actually manufactured. So that is why we refer to the formula as standard cost for actual production. Standard cost for actual production. Now, variable overhead, similar to other overheads, is divided into two. One is variable overhead efficiency variance. And the other is variable overhead expenditure variance. So again, in concept they still remain the same. In material we call it usage and price. We call this efficiency as usage. In labor we call it as efficiency itself. Coming to variable overhead expenditure variance, in material we call it as price variance. In labor we call it as rate variance. In variable overheads we call it as expenditure variance. The formula still remains the same. So what is the formula? So for standard cost for actual production, ultimately the formula is still standard hours into standard rate, or it could be standard quantity into standard rate minus actual hours into actual rate, or actual quantity into actual rate. So why two different formulas? In material we had one, in labor we had one. Why do we have here quantity or hours? Variable overheads are usually dependent on something. Variable overheads are usually dependent on either material or labor hours, either the quantity of material or on the labor. Right? So that is why if the variable overheads are dependent on my labor, then we use hours. We will use standard hours and actual hours. If the variable overheads are dependent on my material, then we use actual quantity and standard quantity. Again, the efficiency formula, similarly like we did it in our labor and materials, it would be standard hours into standard rate minus standard rate into actual hours. Here it would be standard rate into actual hours minus actual hours into actual rate. Right? Again, if it is dependent on the material, my formula would change to standard quantity into standard rate minus standard rate into actual quantity. This would be standard rate into actual quantity. Minus actual quantity into actual rate. Right? Now, in variable overhead variances, we do not have the third level. We do not have the mix and yield variances. So that is kind of a safeguard for you. You do not have to remember those here. This is it in variable overhead variances. So we only have to calculate 3 different variances. So now let us look at a problem. Let's read the problem first. From the following information of G Limited, calculate variable overhead cost variance, variable overhead expenditure variance, variable overhead efficiency variance. So the information provided to us is budgeted production is 6,000 units, budgeted variable overhead is 1,20,000, Standard time for 1 unit of output. Standard time for 1 unit of output is 2 hours. Actual production is 5,900 hours. Actual overhead incurred is 1,22,000. Actual hours worked is 11,600. Actual hours worked is 11,600. So first, like we did it in material and labor, first we will write down the information which is provided to us in the table. However, there is slight change in the table here. Earlier we only captured standard and actual, the data for standard cost and actual cost. Now we will also capture additional information which is provided, that is the budgeted cost. So first we will take the budgeted output. Let's say budgeted output. Budgeted output. Right. Next we have budgeted cost. Budgeted cost. Then we will capture our standard hours. Standard hours. Then standard rate. Then we will capture standard rate. And then we have standard cost. Then we have standard cost. Then we will capture our actual hours, actual rate, and actual cost. We also have one more information, which is the actual output. Let's say actual output. Actual output. Now let us fill the information. First they give us the budgeted production, that is our budgeted output, which is 6,000 units. 6,000 units. Then we have budgeted cost, which is 1,20,000. Budgeted cost of 1,20,000. Right? Do we have standard hours? Now the question says standard time for 1 unit of output is 2 hours. This is standard hours for 1 unit of output. 1 unit of output. So this is not my standard hours. This is not my total standard hours. This is standard hours for just 1 unit of output. So we will not write, or we will not take this as a standard hours. We will have to compute our standard hours. We will come to that later. Now standard rate. Has the question given the standard rate? No. What does the question give? Question gives us the budgeted cost, which is 1,20,000, and it gives us the budgeted output, which is 6,000. It gives us the budgeted quantity and the budgeted cost. So how we calculate standard rate is we take our budgeted cost divided by budgeted output. We take our budgeted cost divided by budgeted output, which is 1,20,000 divided by 6,000. 1,20,000 divided by 6,000, which comes to 20, which will come to 20. Right? So this is my standard rate. This is my standard rate. Next, do I have the standard cost? No. The question is silent about standard cost. So we will move on. Actual hours. Does the question give us the actual hours? Yes. If you read the last information which is provided, that is actual hours worked. Actual hours worked. So in labor, we had two different types of hours. In labor, we had two different types of hours. That is, one is actual hours paid and other one is actual hours worked. Let's say you in the examination you are given a question wherein they ask to calculate both labor hours, labor cost variance and variable overhead cost variance, and variable overheads are dependent upon labor hours, right? And incidentally the question also talks about idle time. So for calculating variable overheads, which hours will you take? Will you take actual hours paid or actual hours worked? So for calculating variable overheads, we will always take actual hours worked. We will always take actual hours worked, not paid. We will never take paid for variable overheads. We will always take actual hours worked. So the actual hours given to us is 11,600. Right? Now, moving on. Do we have the actual rate? No. The question is silent about actual rate. So we will move on. Next, actual cost. Does the question give us the actual cost? Yes. It says the actual cost is 1,22,000. The actual cost is 1,22,000. Next, the question also gives us the actual output. The question gives us the actual output. What is the actual output? 5,900 units. The question says the actual output is 5,900 units. Now, we have captured all the information which is available in the question. Now we will fill in the information which is not in the question, however it is required for us to compute, our variances. So what is left out? Standard hours. So how do we calculate standard hours? The question says that the standard time for manufacturing one unit, the standard time to manufacture one unit is 2 hours, right? Then what will be the hours required to manufacture my actual output? What will be the hours required to manufacture my actual output, which is 5,900. So how do we calculate is, my actual output is 5,900, standard hours per unit is 2. So if we multiply these two, we get 11,800. This is my standard hours. So remember, do not take budgeted into standard rate. Do not take it as 12,000, which is 6,000 into 2. No, do not do that. That is wrong. If you read the formula, it says standard cost for actual production. What is my actual production in this case? 5,900. So if it is 5,900, what should be the hours which I should take? To manufacture 5,900 units? 11,800. Right? Now, moving further. Next, we need our standard cost. So now we have our standard hours, we have our standard rate. So our standard cost will be simple. We just multiply these two, 11,800 into 20, we get 2,36,000. Oh, sorry, I made a mistake. Our standard rate will not be 20. Why it will not be 20 is 20 rupees. What we did was, we did 1,20,000 divided by 6,000. Right, we got 20. 1,20,000 divided by 60. This is 20 rupees per unit. This is my standard rate, 20 rupees per unit. But we need standard rate per hour. So what will we do further is 20 divided by 2. Why 2? 2 hours are required to manufacture 1 unit. So per hour my standard rate will be 10. So this is per hour my standard rate will be 10, right? So it is not 20, it should be 10. We should take in terms of hours, because we are taking our standard hours. We are not taking standard quantity and actual quantity. We are taking standard hours and actual hours. So our standard rate should also be in terms of hours and actual rate should also be in terms of hours, right? So my standard cost is going to be 1,18,000, which is standard hours into standard rate. Next, coming to actual rate, we have our actual cost, we have our actual hours. So we have to just divide our actual cost by actual hours, which is 1,22,000 divided by 11,600. We get 5172, right? So it is recommended, I would always recommend you to use 4 digits for your 4 digits after decimal for your calculation purposes, because that is going to give you the most accurate answer, right? The more number of decimal places you use, the more accurate your answer is going to be. However, 4 should be more than sufficient, be it for standard costing or your financial management or accounting or anything. Now we have computed all the required information. We just have to put it into the formula and calculate the variances. So first we will calculate variable overhead cost variance. Variable overhead cost variance. What is the formula? Standard cost for actual output. Standard cost for actual output minus actual cost. Standard cost for actual output minus standard cost, or we can write it as standard hours into standard rate minus actual hours into actual rate. Right? So the standard cost for actual output is equal to 1,18,000. How is it standard cost for actual output? Because our standard hours is based on my output, which is 5,900. My standard hours is based on my output. It is not based on budget. It is based on output. So what will we get? We will get 1,18,000 minus 1,22,000, which is equal to 4,000 adverse. Why adverse? Because my actual cost is more than my standard cost. Moving on, next is variable overhead efficiency variance. Variable overhead efficiency variance. The formula is standard hours into standard rate minus standard rate into actual hours. Minus standard rate into actual hours. So standard hours into standard rate, we already know it is 1,18,000, minus standard rate is my 10, and actual hours is 11,600. So the variance for this would be 1,18,000 minus 1,16,000, which is 2,000 favorable. 2,000 favorable. Next, we have variable overhead expenditure variance. Variable overhead expenditure variance. So the formula for this would be standard rate into actual hours minus actual hours into actual rate, which is equal to standard rate into actual hours we have calculated in the previous step, which would be 1,16,000, minus actual rate into actual hours we have the actual cost, which is 1,22,000. So this comes to 6,000 adverse. 6,000 adverse. Right? Then after computing the variances, we can also do our check. Right? What is the check? Variable overhead cost variance is equal to efficiency variance plus expenditure variance. Efficiency variance plus expenditure variance. So what is my efficiency variance? 2,000 favorable, and plus what is my expenditure variance? 6,000 adverse. So the total of this would be 4,000 adverse. 4,000 adverse, which is equal to my variable overhead cost variance. So this ends our variable overhead problem, right? So I hope you understood variable overhead variances. It is very similar to labor variances and material cost variances. There is not much of complication here. The only thing we include is the budgets. Do not get confused with the budgets. I hope you understood. Budget is just to calculate, or just for your reference, that the company had budgeted this much of cost. However, the standard would be based on my actual output. The budget in this question, let us say my budget was 6,000. So in a month I would have planned to produce 6,000 units. However, I only could produce 5,900 units. Now the reasons could be various for this. We do not have to delve into the the reasons for the differences. The only thing we have to compute is the variance, right? That there is a difference. How much is the difference? We do not have to think about the y right now. whenever we compute any variance, it is always based on my actual output. It is always based on my actual output, not on my budgets. It is not on my budgets. Through the budget, I can only identify what rate I should use, not the number of hours. I can estimate, okay, I am planning to manufacture 6,000 units. For 6,000 units, I need 2 hours, that is totally 12 hours. I need 12 hours. However, when we say actual output, instead of 6,000, I planned to manufacture 6,000, but I could only manufacture 5,000. Let's say I could only manufacture 5,000. So for 5,000, I would need 10,000 hours. So that becomes my standard. It is not 12,000. 12,000 is not my standard. 10,000 will be my standard. Right? Now, next we will look at fixed overhead variances. Now we will talk about fixed overhead cost variances. So first let us understand what is fixed overhead. Let's take an example of two different costs. One, material, and the other one, rent. Right? So material, so whenever we get material is usually material cost is usually calculated in this way. Say for 1 unit we need 2 kg of material. For 1 unit we need 2 kgs of material, and 1 kg of material is, let us say, 10 rupees. 1 kg is equal to 10 rupees. So if I am manufacturing 1000 units, my material cost will be equal to 1000 units into 2 kg per unit into 10 rupees per kg, 10 rupees per kg. So this comes to 2 lakhs. Similarly, if I am manufacturing 2000 units, my cost will be 2000 into 2 into 10, which comes to 4 lakhs. And if I am manufacturing 3000 units, then my cost will come to 6 lakhs. Right? So if you see, with every increase in my with every increase in my production, my variable cost is also increasing. However, now let us look at rent. So I have a factory for which I am paying, let's say, monthly. I enter into an agreement for monthly rent of, let's say, 10 lakhs. Right? Now if I manufacture 1000 units, I have to pay 10 lakhs. If I manufacture 2000 units, again I have to pay 10 lakhs. If I am manufacturing 3000 units, again I have to pay only 10 lakhs. Now if you see here, even though my number of units is increasing, my cost remains constant. And in other words, my cost remains fixed. So this is called as fixed cost. So fixed cost is cost or expense or overhead which does not change with the change in my production level and is fixed in totality. Right? Now with this basic understanding of what is fixed cost, let us understand the variances of fixed overheads. So first we have fixed overhead cost variance. So the formula to calculate fixed overhead cost variance is overheads absorbed for actual output, minus actual fixed overhead. Now what is overhead absorbed for actual output? while we were discussing about variable fixed overheads earlier, we had their standard overheads for actual production. Here also it is similar. However, we do not use the word standard, we use the word absorbed. Now, why do we use the word absorbed? Let's understand with an example. Now, let us say there is a factory who is manufacturing product X. Let us say there is a factory manufacturing product X. Now, the factory budgets total fixed overheads to be 10 lakhs. The factory budgets total fixed overheads to be 10 lakhs and they budget the output quantity also. They budget the output quantity to be 1 lakh units. Right? They budget the output quantity to be 1 lakh units. So, here what we do is we calculate what is the per unit overhead, per unit fixed overhead cost. So, how do we do that? We take 10 lakhs divided by 1 lakh, which comes to rupees 10 per unit. So, what is this? This is per unit cost of fixed overhead, Now, this per unit cost of fixed overhead is called as absorption rate. We call it as absorption rate. This can also be considered as standard rate. So, it is as good as our standard rate. However, we call it absorption rate. In costing, this is more suitably called as absorption rate. In standard costing, we call it as standard rate. However, in general, in costing, this is more suitable to be called as absorption rate, right? So, what is absorption rate? Absorption rate is the rate at which my fixed overhead is absorbed by per unit of my output. Now, to manufacture any output, there are certain expenses, right? There are material expenses, there are labor expenses, there are variable overheads, and there are fixed overheads. Now, material, labor, and variable overheads, they are all variable in nature. So, we already have a standard rate for them. We usually incur those costs per unit. So we do not have an absorption rate. But in fixed overheads, my total fixed overhead cost is fixed. In this case, in our example, it is 10 lakhs. It is going to be fixed, and the number of units is not constant. The number of units can change. My actual number of units can change. So we calculate an absorption rate. That is, if my budgeted quantity is 1 lakh, then per unit of my output, how much of fixed overhead will be absorbed? That is called as absorption rate. So when we say for overhead absorbed for actual output, we have calculated our absorption rate, which is 10, which we will multiply with our actual output. Say in the given example, let us say our actual output comes to 95,000 units. So absorbed overheads would be 95,000 into my absorption rate of 10, which will be 9,50,000. Right? This will be my overhead absorbed for actual output. Right? Now, let us move on to other variances then. Now, next it says actual fixed overhead. Overhead absorbed for actual output minus actual fixed overheads. Now, even though fixed overheads are fixed in total, the expense can still change. The expense which I actually incur can still change. Say in rent, usually it doesn't change because there is a pre-entered contract. That's a standard contract which we have already entered and we know. But there could be other expenses. Let us assume now there is a machinery which needs regular maintenance. right? There is a machinery which needs regular maintenance, and based on the past experiences we budget a cost of 1 lakh for that repairs. We budget a cost of 1 lakh cost for repairs. However, when we actually repair, we might incur 1,20,000, right? It is again a fixed cost. It is not related to my production, it is not related to per unit production, right? Whether I use the machinery or not, I have to maintain the machinery. It's a fixed cost for me, right? And I budgeted based on past experience the cost to be 1 lakh, but however the cost actually incurred was 1,20,000. So fixed overheads can also vary. In total it can change, however per unit there is no fixed price per unit for incurring fixed overheads, right? So now fixed overheads are divided into two different variances, that is fixed overhead volume variance and fixed overhead expenditure variance. Fixed overhead expenditure variance. So first let us see fixed overhead expenditure variance. So it is similar to what we did in variable overhead. So what we do is we take our standard rate into budgeted hours minus actual hours into actual rate, right? We take standard rate into budgeted hours minus actual rate into actual hours, and when we come to volume, it is standard hours into standard rate minus standard rate into budgeted hours, standard rate into budgeted hours. And if you have to write the overhead cost variance in the similar way, it would be standard hours into standard rate minus actual hours into actual rate. Now further volume is divided into three. One is my efficiency, then one is capacity, and the other one is calendar. Right? Now, so efficiency. So the formula would be standard hours into standard rate minus standard rate into actual hours. Capacity would be standard rate into actual hours minus standard rate into budgeted hours. Then what is calendar? Calendar, we calculate the variance in terms of number of days. So how do we calculate is standard cost for, it would be rather we would say standard rate per day. Standard rate per day into actual number of days minus budgeted working days. Standard rate per day into actual number of days minus budgeted working days. So what is calendar? Calendar is, let's say in a month we budget to work for 28 days. In a month we say that we will run our factory for 28 days. However, we could only run our factory for 27 days. So there we have lost one working day. So in calendar we calculate what is the variance, what is the difference in cost which is occurring due to that one day, factory not working on that one day, right? That is calendar. In capacity, what do we calculate in capacity? In capacity we calculate that I had budgeted to work for, let's say, 10,000 hours in a month. I had budgeted to work for 10,000 hours in a month. However, I actually worked for only 9,000 hours in a month, right? In capacity, we say I had budgeted to work for 10,000. I have the capacity to work for 10,000 hours in a month. Remember, always budgets are going to be based on my actual capacity. Budgets are always going to be based on my actual capacity. They will not be based on some hypothetical figure. No, budgets will always be based on my actual capacity. What am I actually able to achieve? Only based on that the budgets will be set, right? So I have a capacity of working 10,000 hours in a month, but I only worked for 9,000 hours. So the difference or the variance occurring because of this less number of working for less number of hours, we get capacity variance, right? Efficiency variance. In efficiency variance is, now let's say to produce 10,000 units I need 20,000 hours. To produce 10,000 units I need 20,000 hours, but I produced 10,000 units. Actually, to produce 10,000 units I took only 19,000 hours, right? Listen again. So to produce 10,000 units I needed, my standard hours would have been 20,000. To produce 10,000 units my standard hours would have been 20,000. However, I took only 19 hours to produce those 10,000 units. I took only 19 hours to produce those 10,000 units. So the variance occurring because of this efficiency. Now again, as we had discussed in labor also, efficiency can be either inefficient, that is I have used more hours, or it could be over efficient where I have used less hours, right? So the variance occurring due to my efficiency is called as efficiency, as that is the job which I was able to achieve in 10 hours or 20,000 hours, as in our example, I have achieved its 19,000. So that is over efficiency. If I had taken more than 20,000 hours, it becomes inefficiency. Now expenditure, again expenditure is similar to what we had discussed in variable also. Expenditure means I had budgeted to spend 10 lakh rupees, but I have actually spent 60,000 rupees. So the variance between budget cost and my actual cost is called my expenditure variance. Now coming to fixed overhead volume variance. Volume variance is, now let's say in a month I had capacity to run 50,000 hours. I have the machinery and the labor who can work in total 50,000 man hours. I have the capacity of working for 50,000 man hours, right? In 50,000 man hours, I can produce let's say 1 lakh units. In 50,000 man hours I can produce 1 lakh units. Now I have actually produced 90,000 units in the month. I have produced 90,000 units in the month. For 90,000 units, my standard rate or my standard hours should have been 45,000. My standard hours should have been 45,000, right? So the difference between this 45,000 and 50,000 becomes my volume variance, right? I understand it's a little confusing talking about budget, standard and actual. Next we will take up a problem of fixed overhead variances, and you will have a better understanding of what does budget mean, what does standard mean, and what does actual mean, right? So let's get into the problem now. First, let us read the problem. A company has a normal capacity of 120 machines working 8 hours per day for 25 days in a month. The fixed overheads are budgeted at 1,44,000 per month. The standard time required to manufacture 1 unit of product is 4 hours. In April 2021, The company worked 24 days of 840 machine hours per day. The company worked 24 days for 840 machine hours per day and produced 5,305 units of output. The actual fixed overheads were 1,42,000. The actual fixed overheads were 1,42,000. Now compute the following fixed overhead variances. They want us to compute all the variances, so I'm not going to read that out. Now first let us always we will write down a table, capture all the information. Right now, I had told this previously also, whenever we are doing whenever we are doing overhead problem, whether it be variable overhead or fixed overheads, we will also capture the budget information. We will also capture budget information, then standard, and then the actual. So first let us see budgeted hours. Budgeted hours. How much is the budgeted hours? How do we calculate that? So the equation says we have got 120 machines. We work for 8 hours per day for 25 days in a month. So we'll take 120 into 8 into 25. 120 into 8 into 25. So this comes to 24,000. This will come to 24,000. Next, budgeted fixed overheads. They have clearly given it is 1,44,000. 1,44,000. Right now, next we will come to our standard hours. Standard hours. Has the question given us the standard hours? No, it is not given. We have to compute it. So we will come back later. Next we go to our standard rate. Now standard rate is also the absorption rate. Standard rate is also the absorption rate. And how do we calculate absorption rate? Absorption rate is calculated by taking our budgeted cost which is 1,44,000, divide it by our budgeted hours. What is our budgeted hours? 24,000. So how much do we get? 1,44,000 divided by 24,000. It comes to 6 rupees per hour. Remember, this is per hour, not per unit. It is per hour. Why? Because we have divided it by number of hours. Right? So our standard rate is coming to 6 per hour. Next is our standard cost. Now this standard cost will become our overhead absorbed for actual output. Overhead absorbed for actual output. Why? Is because how do we calculate standard cost? Standard cost is equal to standard hours into standard rate. Standard rate we have calculated, and I have already told you standard rate is equal to my absorption rate. Next, standard hours. Standard hours is always going to be based on the actual output. Standard hours is always going to be based on the actual output for all the variances, not only for overheads, for all the variances. So in the question it says that we have produced 5,305 units. We have produced 5,305 units. So to calculate standard hours, what we will do is we will take 5,305, which is the number of units we have manufactured, into what is the standard hours per unit. Standard hours per unit, they give us 4. So we take the number of units manufactured, 5,305, into 4. 5,305 into 4, we get 21,220. 21,220. 21. This is my standard hours. 24,000 is not my standard hours. 24,000 hours is for manufacturing 6,000 units. How 6,000 units? If you take 24,000 divided by 6, you get 6,000. Right? But we don't need that. So 24,000 is what I had budgeted. I told that I will work for 24,000 hours in the month. I said my factory is going to run for 24,000 hours in the month. Okay. Now if I had actually worked for 24,000 hours, I would have produced 6,000 units. But I have produced how much? 5,305 units. I have produced only 5305 units. So how many hours should I take to produce 5305 units? To produce 5305 units, how many hours should I work as per my standard rate? It is 21,220 hours, right? Next we will see our actual hours. What is my actual hours? The question says we have worked for 24 days. Question says we have worked for 24 days and per day we have worked for 840 hours, right? So 24 into 840, we get 20,160. Now do not say that in a day there are only 24 hours. How can you work for 840 hours? This 840 hours is put together for all the machineries. See, in the first line of the question it says we have got 120 machines and per machine works for 8 hours in a day. So if you take all the machines, 120 into 8, if you do 120 into 8, every day I have 960 hours. I have 960 hours, right? So in that way I have 840 hours. I have worked for 840 hours in a day. That is, my factory, including all the machines, was running for 840 hours in a day. This is called as machine hours. So we have forgot to calculate the standard cost. Its standard cost will be standard hours into standard rate. So which is 21220 into 6. You get 1,27,320. Right. Next, we have to calculate our actual rate. Has the question given the actual rate? No, and it will never give ideally. Why? Because as I said, fixed overheads are fixed in nature. You cannot give it has a per unit cost. Fixed overhead is always fixed. You cannot give it as a per unit cost, and we ideally do not even need to calculate actual rate. Rate per unit, actual rate per unit. However, to keep our table constant, or to keep our template ready for all the problems, we will still compute it. However, since we don't have the information in the question, we will get back to this later. So next we have to calculate our actual cost. What is the actual cost? The question clearly says the actual cost is 1,42,000. So now the actual rate will be 1,42,000, which is my actual cost, divided by the number of hours, actual hours, which is 20160. I get 7.0437. As I told you earlier also, if you get decimals, use 4 decimals for calculation, and in the end you can round it off either to 2 or to 0 decimals also, depending on the question obviously. So now let us calculate our variances. First we will go in the order the question asks us. First we have efficiency. Efficiency variance. What is the formula for efficiency variance? It is standard hours into standard rate minus standard rate into actual hours. Standard rate into actual hours. How much is my standard hours? Standard hours into standard rate we have already calculated it to be 1,27,320. 1,27,320. So 1,27,320 minus standard rate is 6 into actual hours 20,160. Now how much is this? We get 6,360 favorable. Get 6,360 favorable. Next, we will calculate our capacity variance. Capacity variance. So what is the formula? standard rate into actual hours minus standard rate into budgeted hours. What is my standard rate? 6 into actual hours, 20,160 minus standard rate again 6, my budgeted hours. Now in the table we have written our budgeted hours to be 24,000, correct, but there is one small catch here, that is the budgeted hours are for 25 days. The budgeted hours are for 25 days. So if you look at the question, the budgeted hours have been done for 25 days, correct? However, we have worked only for 24 days. We have worked only for 24 days. So when we calculate our capacity, we will only take 24 days. We will take the budgeted hours for 24 days. We will not take for the whole 25 days. We will only take it for 24 days. So the formula, so how do we calculate this would be 120 into 8, that is 120 number of machines into 8 hours per day into 24 days, right? So we will get 17,280 adverse. We will get 17,280 adverse, right? So remember, whenever we are calculating capacity variance, we will take the actual number of days worked, that is the in other terms the budgeted hours will be budgeted hours for actual number of days worked. So this budgeted hours will be budgeted hours for actual number of days. This is only for capacity. This is only for calculating capacity variance. Remember, this is only for calculating capacity variance, right? Next, next we will take calendar variance. Next, let us see calendar variance. So the formula is standard rate per day into actual days minus budgeted days. I am writing in shortcut, however you should write the full formulas in the examination. Do not write it as budgeted days, write it as budgeted working days, and it is not actual days, it is actual number of days worked, right? You should write the full formulas wherever possible. Though you will not get extra marks for writing full formulas, the marks will definitely be deducted if you don't write it. Now, what is the standard rate per day? How do we calculate standard rate per day? Now, in a day we have 8 hours. In a day we have 8 hours and we have 120 machines. We have 120 machines, and per hour our rate is 6. So this is my per day hour. This is my per day hour and this is my standard rate. This is my standard rate, right? So what we do is we take the number of hours I have in a day. Number of hours I have in a day. I have got 120 machines multiplied by how many hours per machine do I get? 8 hours. So 120 into 8 becomes my number of hours in a day, number of hours available in a day, multiplied by my standard rate of 6 or my absorption rate of 6 becomes my standard rate per day, becomes my standard rate per day. Into actual number of days worked. How many days have I worked? 24. Minus how many days I had budgeted to work? 25. Where do we get this information? Let us revisit our question. So initially I had budgeted to work for 25 days. The first line of the question says the company has a normal capacity of 120 machines working 8 hours a day of 25 days in a month. That means I budget to work for 25 days in a month. However, the second paragraph says in April 2021 the company worked 24 days. The company worked 24 days of 840 machine hours per day, right? So my actual number of days comes to 24. However, I had planned to work for 25. I had budgeted to work for 25. So the variance of this will be 8 into 120 into 6, that comes to 5760 adverse. 5760 adverse. Now next let us calculate our volume variance. So what is the formula for calculating volume variance? It is standard hours into standard rate minus standard rate into budgeted hours. Standard rate into budgeted hours. So what is my standard hours? You can straight away take my standard hours into standard rate would be my standard cost 127,320 minus standard hours into standard rate into budgeted hours. What is standard rate into budgeted hour? It is my budgeted cost, total budgeted cost 1,44,000. Here again we will not take 24 days as we had done in capacity. No, we will not take 24. We will take the total 25 days. How much I had actually budgeted, total budgeted, right? We are not going to compare the number of days worked here. That is only done at the third level. Okay, and only in capacity variance we use the budgeted hours for actual number of days worked. Budgeted hours for actual number of days worked. In all other variances, if it says budgeted hours, it is the total budgeted hours. That is for 25 days in this exam, in this question. So this will be 1,44,000. So how much does this come to? 127,320 minus 144. We get 16,680 adverse. Now the way we did it in different other variances, the check can also be performed here. How can we do the check? Is for volume variance is equal to my efficiency plus calendar plus capacity. How much is my efficiency? 6360 favorable plus how much is my calendar? 5760 adverse plus how much is my capacity? 17,280 adverse. So this total should come to 16,680, but does it come? Let us check. So 6360 minus 5760 minus 17,280 is coming to 16,680 adverse. Is coming to 16,680 adverse, which matches my volume variance. Which matches my volume variance. So the variances what we have calculated are correct. Next, let us move on to our expenditure variance. I am repeating again myself. I am using the shortcuts. I am not writing the full names, but please write the full names in the examination. Please write the full names. Do not write like me. This is only for your understanding purposes, so that we do not utilize our time on writing long words. This is only for your understanding. In the examination, please write the complete word, the full word, and when you are practicing also, I would suggest you to use the complete word. That makes you to get into a habit of writing it fully, and it would save you time in the examination. With my personal experience, I am telling you, it will save you time in the examination. There has never been any practical exam where I have not attempted for 100 marks. I have always written for 100 marks within the allotted time of 3 hours. It does not matter how lengthy the paper is. The paper setter is experienced. He is not some Tom, Dick, Harry who has been picked up from the street and setting a paper. No, he is an experienced person. He is intelligent, more intelligent than you can imagine. They clearly know in 3 hours how much a student can write. They want to judge you on your capacity as well. The question paper which is set, are you able to complete it in 3 hours or not? Ideally, whichever question paper is given to you should be able to be completed in 3 hours. However, there are situations where it might exceed 3 hours, but those are rare cases. It doesn't happen every time. Ideally, any practical, if you have practiced it properly, if you know the solution correctly, you can do it within 3 hours. It is possible to do it within 3 hours. Okay, moving on to our expense variance. So the formula is standard rate into budgeted hours minus actual rate into actual hours. So standard rate into budgeted hours is my total budgeted cost, obviously, which is 1,44,000. Sorry, minus, and actual rate into actual hour is my actual cost, which is 1,42,000. So we will get 2,000 favorable. We get 2,000 favorable, right? Now, if you see, I have not used this actual rate. This actual rate, though I have calculated in a table, I have not used it. Why I have not used it? Because if I use decimals, one thing is I already have the multiplied answer already available to me, and if I use decimals, I usually will get the answer in decimal. It will not be a rounded off whole number. So to avoid those situations, we can directly take whatever is whatever is our actual cost, the calculated figure, and compute it. And you can also do in such a way that instead of writing standard rate into budgeted hours, you can take it as budgeted cost minus the actual cost. That is also okay. That would be better if you're not using the actual rate. Now coming to our fixed overhead cost variance, our formula is standard hours into standard rate minus actual hours into actual rate, right? So what is my standard hours into standard rate? That is my standard cost. That is the overhead absorbed for actual output, which is 1,27,320. This figure, 1,27,320 minus my actual cost, which is 1,42,000. This will come to 14,680 adverse. 14,680 adverse. You can check on your calculators. 14,680 adverse, right? Again, further you can do a check as well. Check is volume plus expense is equal to fixed overhead cost variance. Volume plus expense is equal to fixed overhead cost variance. So if you see minus 16,680 plus 2,000, you get minus 14,680, right? And as discussed earlier, do not use this signs, do not use this mathematical signs of plus and minus. What we will do is, we will write, if it is negative, we write it as adverse. If it is positive, we write it as favorable. Do not write these signs, right? Yeah. So this is the basic questions which you can expect for all the variances. Next we will look at one more question of calculating variances, where we will have both variable variances and fixed overhead variances. Now we will do a problem wherein we will calculate both variable overhead variances and fixed overhead variances. First, let us read the problem. The following information was obtained from the records of manufacturing unit using standard costing system. Production standard 4000 units, actual 3800 units, working days 20, actual 21, machine hours 8000 hours, actual 7800 hours, fixed overhead standard 4 lakhs, actual 3,90,000, variable overhead standard 1,20,000, actual 1,20,000. So you are required to calculate the following overhead variances: variable overhead variances and fixed overhead variances. Now in the problem they do not say which types of variances. They say flat, variable and fixed. They do not say in variable which types of variances and in fixed which type of variances. So we will have to compute all the possible variances. First we will start with variable overhead variances, and then we will go to fixed overhead variances. Now before solving the question, first we need to capture all the information which is provided in the question, and then calculate whichever additional information will be required to calculate the variances. So first we will start with our budgeted hours. Then we will calculate our budgeted cost. Then we have standard hours, standard rate, standard cost, actual hours, actual rate, actual cost. Now this will be for variable, this will be for fixed, right? We will use the same table for both, since the information required is similar. Now budgeted hours. So what does the question say? So machine hours, it says 8000 hours standard. Even though the question says standard, that will be taken as budgeted hours. Why? Because in the first line of the table, the question says the production standard is 4000 units. When they say our standard production is 4000 units, that means that is the budget, because whenever we calculate standard cost, it is always based on our actual numbers. So 8000 hours is required to manufacture 4000 units, but 4000 is not my actual number of units. So that becomes my budgeted hours. So my budgeted hours would be 8000. Similarly, it would be 8000 for fixed as well. My budgeted cost, they have already given what is the standard cost. When they say standard cost, total standard cost for fixed overheads and variable overheads, the actual quantity which they are basing is 4000. But for our standard costs, the actual quantity should be, the base should be my actual quantity, right? Since the base is 4000 units, which is not my actual quantity, that is my budgeted cost. Even though the question says has standard, the question has named it as standard, we will have to take it as budgeted cost. So variable is 1,20,000 and fixed is 4 lakhs. Now standard hours, we will come to it little later. Let us go to standard rate. Here we will calculate standard rate per hour. So this is going to be per hour, right? So how will we do it? We will take our budgeted cost, that is 1,20,000, budgeted cost 1,20,000 divided by 8000, which is our budgeted hours. Then we get our standard rate. Remember, budgeted rate, standard rate and absorption rate are all the same. Budgeted rate, standard rate and absorption rate are all the same. This comes to 15 for variable, and similarly we will have to do it for fixed, which will come to 50. Now standard cost, we do not have the information in the question, neither can we calculate right now, so we will skip. Actual hours. Now the question straight away gives us the actual hours, which is 7800. So we will just take 7800. Now actual rate, does the question talk about actual rate? It is not talking about actual rate, so we will skip this for now. Next, the question gives us what is the actual cost, what is the actual overheads incurred. So for fixed it says 3,90,000 and for variable it says 1,20,000. Now since we have our actual cost, we have our actual hours, we can calculate our actual rate. So 1,20,000 divided by 7,800, we get 15.3846. 15.3846. Next, we will calculate our actual rate for fixed overheads. 3,90,000 divided by 7,800, we get 50. We get 50. Right? Now, coming to our standard hours. Right? How will we calculate standard hours? See, the question says to manufacture 4,000 units. I need 8,000 hours. So to manufacture 3,800 units, how many hours do I need? Don't say it is 7,800. 7,800 is the hours I have actually taken. But how many hours should I actually taken? Right? Means in what is the standard, what is the normal number of hours I should have taken to manufacture 3,800 units. So how we will do this is 8,000 divided by 4,000 into 3,800. So 8,000 divided by 4,000 into 3,800. We get 7,600 as my standard hours. Get 7,600. Next, now we have our standard hours, we have our standard rate. So let us calculate our standard cost. So 7,600 into 15, 1,14,000, and 7,600 into 50, 3,80,000. 3,80,000, right? Next, now we have captured all the information which is required for our calculation. So now let us jump into the problem solving. First we will start with variables. So variable overhead cost variance. Variable overhead cost variance. What is the formula? It is standard cost for actual production. Standard cost for actual production minus actual cost. Standard cost for actual production minus actual cost. Now, what is my standard cost for actual production? It is nothing but my standard cost, 1,14,000 minus actual cost is 1,20,000. How much do I get? 6,000 adverse. I get 6,000 adverse, right? Next, we have variable overhead efficiency variance. Variable overhead efficiency variance. What is the formula? Standard hours into standard rate minus standard rate into actual hours. Standard rate into actual hours. So what is my standard hours into standard rate? Standard hours into standard rate is nothing but my standard cost. I can straight away take that. Minus what is my standard rate? 15 into what is my actual hours? 7,800. 7,800. This is my actual hours. So we get 3,000 adverse. Get 3,000 adverse, right? Next, let us calculate variable overhead expenditure variance. Variable overhead expenditure variance. So what will be the formula for this? Standard rate into actual hours minus actual rate into actual hours. What is standard rate into actual hours? We have already seen here, 15 into 7,800 minus Actual rate into actual hours is nothing but my actual cost, which we have already computed here, 1,20,000. So again we get 3,000 adverse, 3,000 adverse. So this completes our variable overhead variances. There are only three types of variable overhead variances. First is the variable overhead cost variance, and which is divided into another two variances: variable overhead efficiency variance, variable overhead expenditure variance. Since we have computed all the three variances, we can move on to fixed overhead variances. First, let us calculate fixed overhead cost variance. So again, the formula is what? The formula is overhead absorbed for actual output minus actual cost. Overhead absorbed for actual output minus actual cost. In variable overheads, as I've already explained to you, standard cost for actual production and variable overhead absorbed for actual output are the same terms, and the calculation for these are also same as we have it in material and labor, that is standard hours into standard rate. The only thing is, in material and labor usually we do not get budgets. We straight away get what is standard and what is actual. But when we talk about variables, when we talk about overheads, the question usually talks about budgets, and we have to calculate what is standard. And remember, standards are always going to be based on my actual output. Standards are always going to be based on my actual output. This holds good for all the variances: material, labor, variable overhead, fixed overhead. This holds good for all the variances. Standards are always based on my actuals. So in this question, if you still don't know what is overhead absorbed for actual output, you can also do it this way. You can take standard hours into standard rate minus actual hours into actual rate. You do this, you will get the same answer again. You will still get the same answer. But however, I recommend you to use the first formula for variances, at least for standard, the main variance, that is the cost variance for both variable and fixed. It is a more sophisticated approach. So overhead absorbed for actual production, as I said, it is nothing but our standard cost, which is 3,80,000, minus what is my actual cost, 3,90,000. So we get 10,000 adverse. Right? Next, let us calculate fixed overhead expenditure variance. Fixed overhead expenditure variance. So what is fixed overhead expenditure variance? It will be standard rates into budgeted hours minus actual rate into actual hours. Correct? Yes. So what is my standard rate? So again, if you see here, standard rate into budgeted hours is as good as saying it is my budgeted cost. It is my budgeted cost. How? See, how did we calculate our standard rate? We took our budgeted cost, which is 4 lakhs, then divided it by the budgeted hours, 8,000. Right? Now, if you take my standard rate, which is 50, and multiply it with my budgeted hours of 8,000, you will get your budgeted cost. We are calling it standard rate, but as I told you earlier also, standard rate is equal to my absorption rate and budgeted rate. Standard rate is equal to budgeted rate and absorption rate. So how much is my standard rate into budget? I will get 4 lakhs. If you want to check, you can check 50 into 8,000. 50 into 8,000. You will get 4 lakhs. That is my budgeted cost. minus we will take our actual cost. Actual cost is 3,90,000, which is equal to 10,000 favorable. So I had budgeted an expenditure of 4 lakhs, but my actual expenditure came out to be only 3,90,000. So I am saving 10,000. Next we have fixed overhead volume variance. Fixed overhead volume variance. So what is the formula? It is standard hours into standard rate minus standard rate into budgeted hours. Again here, so standard rate into standard hour. What is standard rate into standard hours? My standard cost, and standard cost means overhead absorbed for actual production. Overhead absorbed for actual production. You call it production or output, it doesn't matter, it is the same thing. So this first step, which is 3,80,000 standard hours. If you want to check, you can check 7,600 into 50, you will get 3,80,000. Minus, we have already seen standard rate into budgeted hours is my budgeted cost, which is 4 lakhs. How much do I get? 20,000 adverse. 20,000 adverse. Right? Next, moving on. Fixed overhead efficiency variance. Next we will do fixed overhead efficiency variance. Here, don't get confused with fixed overheads and variable overheads. In fixed variable overheads, efficiency variance comes at the second level itself. However, in fixed overheads, efficiency comes at the third level, right? The formula still remains the same. Coincidentally, not coincidentally, actually that is how the formulas have been designed. That is how costing works, to be frank. The formula still remains the same, which is standard hours into standard rate minus standard rate into actual hours. Standard rate into actual hours. So how much is standard hours into standard rate, which is again my standard cost, which is 3,80,000 minus standard rate into, sorry, this is actual hours. This is actual hours. Standard rate is 50. How much is my actual hours? 7,800. So how much do we get? Get 10,000 adverse. We get 10,000 adverse. So efficiency variance is 10,000 adverse. Next, fixed overhead capacity variance. Capacity variance is basically how much capacity have I utilized. So how do we calculate that? Is standard rate into actual hours minus standard rate into budgeted hours. Standard rate into budgeted hours. What is standard rate into actual hours? 50 into 7,800 as we had computed in the previous step, minus standard rate is how much? 50 into. Now here there is a small catch. We had discussed this in the previous problem as well. What is that small catch? When we are doing capacity variance, we will take budgeted hours for actual number of days worked. We will take for capacity variance, BH is equal to budgeted hours for actual number of days worked. Actual number of days worked. So if you see the question now, what does the question say? The question says that in a month my usual working days are 20. but actually I have worked for 21 days. I have actually worked for 21 days. So for 20 days my budgeted hours are 8,000. For 20 days my budgeted hours are 8,000. So how many hours would it be for 21 days? So how do we calculate it? We will take 8,000 divided by 20 into 21, get 8,400. So the calculation will be 8,000 divided by 20 into 21, right, which is equal to 50 into 7,800 is 3,90,000 minus oh, yeah, 50 into 7,800 is 3,90,000 minus 50 into how much is this, 8,000 into 21 divided by 20, we get 8,400. So how much will this come to? 50 into 8,400 is 4,20,000 minus 3,90,000. We get 30,000 adverse. Get 30,000 adverse. So for 21 days, I had the capacity of working for 8,400 hours. So what this variance tells us is, for 21 days, I had the capacity of working for 8,400 hours. But how many hours did I actually work? 7,800. So 600 hours is a loss. 600 hours at a standard rate of 50, I get 30,000 adverse. Next we have to calculate fixed overhead calendar variance. Fixed overhead calendar variance. What is fixed overhead calendar variance? The formula is standard fixed overhead per day. Standard fixed overhead per day into actual number of days worked. Actual number of days worked minus budgeted number of days. Actual number of days worked minus budgeted number of days. So standard fixed overhead rate per day. Standard fixed overheads per day. What is my standard fixed overhead per day? Does the question say anything about that? No. But the question says is my total budgeted overheads is 4 lakhs for a month. My budgeted overheads is 4 lakhs for a month, and I budget to work for 20 days in a month. I budget to work 20 days in a month. So what we will do is take 4 lakhs divided by the number of days, that is 20. We get per day fixed overhead rate. We get per day fixed overhead rate. So what we will do is we will take 4 lakhs divided by 20, multiply by actual number of days worked is 21 minus budgeted number of days is 20. So the question here says the actual number of days I have worked is 21 and the budgeted is 20, right? So the difference of this will give us the calendar variance. So how much is 4 lakh divided by 20? 4 lakhs divided by 20, we get 20,000. We get 20,000, and this is favorable. This is favorable. Why? 20,000 into 1 will be 20,000 with, and we get positive, so it is favorable. Now you can also perform a check. We have computed all our variances which are required, both fixed and variable. You can perform a check. Let's first start with variable overheads. If you add efficiency and expenditure variance, you should get your cost variance. Do we get that? 3000 adverse plus 3000 adverse, we get 6000 adverse. So that is correct. Coming to our fixed overhead cost variances. In fixed overhead cost variance is 10,000. If we add our expenditure variance and volume variance, we should get fixed overhead cost variance. My expenditure is 10,000 favorable. My volume is 20,000 adverse. If we add these two, we get 10,000 adverse. Does it match with our cost variance? Yes, it does. So this is correct. Next, coming to volume. Volume is combination of my efficiency, my calendar, and my capacity. If we add these three, we should get our volume variance. Do we get that? What is my efficiency? 10,000 adverse. What is my capacity? 40,000 adverse. If you add these two, it becomes 30,000 adverse. My capacity is 30,000 adverse, not 40,000. If we add these two, we get 40,000 adverse. Then we have to add the calendar. How much is the calendar? 20,000 favorable. So 40,000 adverse plus 20,000 favorable, we get 20,000 adverse. Does it match with my volume? It is matching, right? So this ends our problem. Now we have computed now we have calculated all the variances which were required in the problem. One second. Yeah. So I hope you have understood the variances, how to calculate it. This ends our topic of standard costing. However, if I do find any additional problems which are interesting and complicated, and I feel that you would benefit from it, I will definitely post videos on that. For now, we have covered what is standard costing, what are the types of standard costing. We have seen how to compute material variances, labor variances, variable overhead variances, and fixed overhead variances. If you feel like you need explanation on anything from standard costing, any further explanation, you can definitely write your thoughts in the comments below, and also you could write a mail to me. You could also give me the feedback on the video. You could send me your questions if you have any problems you want me to solve. I will definitely try to make a video. Please like, share and subscribe. Definitely share the videos with your friends, colleagues and your fellow batchmates. Thank you.